one corporate to another, then Muthoot Microfin is in focus on the back of results that it reported, and it has reported strong AUM growth in the quarter gone by, which stood at about 14%. That's the kind of growth on AUM front for YOI. What's the outlook going forward? To discuss that, we are now joined by the CEO of the company, Sadaf Saeed, now joining us. Thank you so much for taking your time out. And first up, we have to talk about AUM growth. You've given a guidance of 12 to 15% for FY27. Now, this is muted as compared to what you've reported in the fourth quarter. What factors are leading to a more calibrated growth outlook, if you can take us through that?
No, thank you, first of all, for having me. I think it's important to lay out the context. In a year where the industry has almost degrown by 20%, Muthoot Microfin grew by 13.3%. And in terms of our guidance, we had guided that we will be achieving 14,000 crores of asset under management, and we have stood firm on our guidance, and we have achieved that. I think more important to realize is for a financial services company, there are three key fundamentals. One is your consistent AUM growth, which we have demonstrated with our AUM growth of 13% and reaching 14,000 crores of AUM. The second aspect is asset quality. I think this last year was very, very important for us. We had certain strategies laid out, and they have played out well for our asset quality has improved significantly. From GNP of 4.85%, we have brought that GNPA down to 3.89%. So 95 basis point of improvement on GNPA. Net NPA remain very low to 1.2%. So 20 basis point reduction there. And our provision coverage remains strong at 71%. But most heartening fact is that our collection efficiency has improved significantly. Whereas in the last year, same quarter, the collection efficiency was just about 90.6%. It has come to around 96.48%. So almost 575 basis points of improvement. And this is brought about by the strategy that we have adopted of diversifying our asset class. So we have introduced a new product called individual loan. In that business, we have already built a 2,300 crores of asset under management, and that's supreme quality. There is zero delinquency there, zero 30 plus. And as of now, the performance of the portfolio is really, really well. I think apart from this, I think for a financial services entity, what is more important is how's the cost of fund. And in the year which has just completed, we have reduced our cost of fund by 75 basis point. Our overall cost of fund for the last financial year was 11.02%. This year, our cost of fund is 10.23%. So that has really, really helped us to improve our profitability. And if you look at our total contribution to net worth, including the OCI, we have contributed around 217 crores to our net worth. The PAT is 170 crores. There is an OCI component which is there of around 40 crores. So total 217 crores, which we had guided that we will be achieving around 200 crores plus addition to the net worth. So on the guidance front, on the AUM, we have achieved. On the credit cost, we have achieved. We had guided a credit cost of 4 to 6%. Our credit cost has come down to 3.5%, so which is much better than our guidance. And standalone for the quarter, it has come down to 2.8%. So going forward, I think that is going to play out and improve our ROA. We had guided for an ROA of around 0.5 to 2%. For the standalone quarter, we are at 2.1% ROA. And for the full financial year also, we are at 1.7% ROA. So from that perspective, the company, whatever guidance we had put out, we have achieved. There are certain work in progress, which is in terms of NIM improvement, as I think our newer portfolio that we have originated at a higher yield will continue to accumulate in the book. The weighted average yield on the portfolio will also improve, and the NIMs will also improve.
All right. Good morning, and great numbers indeed. But just wanted to touch on the NIMS part, because since you have been highlighting that is expected to improve. So any number in mind that you can help us with? What is the target on that front? And also, since the credit cost has also moderated sharply in Q4, should this be considered as the normalized rate going ahead, or there's a risk of volatility in this number as well?
Yeah, very important. I think on the NIM front, we are guiding around 12.5% NIM in the next financial year and going towards around 13% in the following financial years. And from the asset quality perspective, I think one is the core business, which is the JLG loan that has improved. The collection efficiency there has definitely improved. But our asset quality further is improving because of the portfolio diversification that we are doing. So we have introduced products like individual loan, loan against property, and gold loan. And at the beginning of the year, we had 97% of our book as JLG and 3% as non-JLG. Today, that stands at around 83% JLG, 17% non-JLG. And this is also above our guidance. We have guided for 85-15, but we have achieved more than that. And the portfolio that we have originated this year, around 57% of the book that we are having in our balance sheet today is originated this year. In that portfolio, the asset quality is very, very good. 30 plus is only 0.8%. So from that perspective, we can say that the steady state asset quality has been achieved, which has been our consistent performance. The credit cost would be for the future would be in the range of 2.5 to 2.75%, which will ensure that we will reach 3 to 3.5% ROA in the coming year.
Right. Also wanted your thoughts on credit costs, which has moderated sharply in the fourth quarter. Should this be considered the normalized run rate going ahead, or are there risks of volatility due to unstructured nature of the portfolio?
So I think this is what we are used to in terms of credit costs. There is further scope of improvement. We guide that in a long-term basis, if you look at the credit cost should be 2.5%. And this is what it has been in the previous year prior to the crisis years. So I think we have already achieved that. And with the diversification strategy that we have put in place, I think this will continue to improve further. But we are guiding towards around 2.5% credit cost. The most important part is the yield will expand in our portfolio. Our yield on the portfolio is around 18.8%. Overall, it will expand to around 200 basis points. So we are likely to cross around 20% in terms of yield. And our cost of funds are coming down. And at the same time, credit cost is also coming down. And then our OPEX is also rationalizing because we are doing more business with the same number of branches or lesser number of branches. Our average outstanding per branch has improved by 1 crore. We were at 7.2 crores. It is now 8.3 crore per branch. Our productivity for field staff has also improved, where one field officer was managing portfolio. Now he's managing around 1.5 crore portfolio. So overall efficiencies are kicking in. Our operating cost, OPEX, has come down from a peak of 7% to 6.4%. This is further likely to reduce in coming years. So definitely, I think from an ROA, ROE perspective, we are likely to see much better performance in coming year, and credit costs will remain within this range of 2.5%.
All right, and we look forward to that. With this, Mr. Saeed, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you. Thank you very much for having me.
All right, but with this, viewers, we are completely timed out in this edition of Midcap Masala. It's a goodbye from me and Ashesha and the entire team who put this show together. Thank you so much for tuning in, but don't go anywhere. Bye now. Till now, we'll take the action ahead.